We want to stick within the tech sector. Big tech companies looking for an edge in AI, including Meta, which plans to spend up to $40 billion on AI investments this year. Our next guest saying that Meta AI initiatives has, quote, moved the stock into Apple's turf and merits Apple's multiple. Let's talk about it. We are joined by Wall Street's biggest bull on Meta, Barton Crockett. He's Rosenblatt Equity Research Analyst, and he has a buy rating on the stock, an $811 price target. Barton, it's great to have you here. So talk to me about this massive rally that you're expecting in Meta. You're looking at shares rallying about 40% from where they're trading today. Why do you argue that Meta's growth merits a much higher multiple?
Well, I think the growth, that's it. I mean, the growth supports the multiple. We think that these guys over the 3-year CAGR are going to be growing EPS, excluding unusual items, over 30%, which we think is supportive of a 30 PE multiple in the most simplistic kind of way of thinking about it. The bigger backdrop we think is that people are getting more comfortable with Meta's strategic positioning. Their investments in AI have yielded improved return on investment for marketers, better engagement from users. And this is, they've kind of led and developed this direct marketing to kind of smaller, mid-sized companies globally. This kind of almost new niche that they've pioneered and owned, and they're making these people more productive, and they're spending more, and they're taking share even at massive scale. So we think all of that gets the market, more willing to give these guys a premium multiple. And frankly, I think the big worry on the stock historically has been spending, right? In particular, their investments in their reality segment, which I think are overdone and are not going to generate a return that we think pencils out commensurate to the investment. But they are executing better. I mean, I think that their devices that they were showing off at their recent Meta Connect, they're more resonant with the consumer than even what Apple is doing right now. And their Ray-Ban glasses could actually be something of a hit this Christmas. So all of that we think makes people more comfortable, but mainly the growth supports it.
Barton, I was just going to ask you about that. I mean, what type of time frame or lead do you give to Meta in proving to the street that can be a contributor to the financial performance, and that the street should trust future iterations that this company is going to invest in? Because as the old adage goes, hardware is hard, and Meta has certainly been looking for the opportunities to, where they don't have a smartphone device, really tap into what could be the next leg or next wave that consumers hop on.
Yeah, I mean, the amazing thing is that they don't ever have to make money in this. We don't assume they do, for the earnings growth to be impressive enough and to support the equity from here. If they did, that'd be a huge upside. We think on pace to lose 17 billion-ish this year in operating profit on reality, and that's going to be more than they lost last year. They probably lost 60 billion cumulatively on this, and yet they're growing EPS at a 30% plus CAGR. So they're so strong in the advertising marketing that they can support, this tax, this basically dreamer's tax on reality, and you can still make a great argument for the stock. So if they can do that, that actually argues that their core business is, even more impressively strong than what you see in the financials. Because arguably you can exclude reality, because at some point one would hope that those losses would go away.
Barton, talk to me just about when you mentioned the fact that these AI investments are expected, and they have, I think, to some degree, shown improvement in ad performance. What do you think that upside looks like just in terms of further improvement, and what exactly that is going to unlock here when you talk about how that fits into the valuation picture?
Well, look, I mean, these guys were growing their advertising revenues at a 20% year-over-year pace in the quarter that was reported for June. We think they'll keep growing at close to that pace in the September ending quarter. That's going to put them up at the very fastest kind of growers in advertising. Nearly twice the growth rate of Google, and right on top of what Amazon is doing with their new ad push, and not too far behind the connected TV darling, The Trade Desk, which is probably growing at about 26% as per consensus. So these guys are large, they're growing rapidly, and that's a very profitable growth stream, those advertising revenues. So That's very supportive, we think, for maintaining a really good trajectory in earnings per share growth. And we think that that's what has powered the stock and will continue to power it, which is why we sit here with the stance that you cited. We have, I think, the street high price target at this point.
Barton Crockett, Rosenblatt Equity Research Analyst. Barton, thanks so much for taking the time here with us today. Appreciate it.
Great, thank you.